So do you know who your worst customers are? All right, this is another Vistage idea. A lot of people know who their best customers are and they want to focus on making those people happy. Well, that's great. But you also need to know who your worst customers are, because sometimes you should fire your worst customers. If you really went and did an analysis, you might find out they don't even make you any money, or it's twice as much work to make the same amount of money. And that's a business idea that we apply to companies. Obviously, Open Mortgage, we have a spreadsheet that Woody creates where we rank every single branch, bank, or TPO that we work with, so we know what is our net profitability from that partner for the last month. And then we can look at that and we can evaluate. It's not just the number of did we make money or lose money or how much money did we make. We also have to add in the factor of are they easy to work with or are they a pain in the butt? A lot of our branches know we have fired people who are a pain in the butt or who are rude to our employees. You have to look at your business the same way. As an individual loan officer, you're a business, you're a profit center. Or as a branch, your branch is obviously a profit center. So you need to put together a little spreadsheet or on a big chief yellow tablet and look at who your customers are. Now as a company, we have recurring customers. We have our same retail branches or TPOs every month. As loan officers, you don't have as much recurring business. It's mostly loans for new people every month. You may do one for a family you've worked with before or a referral, but it's mostly new people. So then you need to look at classes of loans or types of loans. Do you do some govies and some conventional? Or do you do some small loans and some large loans? I hope it's not purchase and refi. I hope you're just focused on purchase. But you need to consider those classes of loans. What do you find when you do govie loans? Are they less price conscious? You can make a better spread because they're just happy to be able to get a loan? Compared to conventionals, you may get ground down to very thin margins. Or maybe you see it the other way, that govies tend to be smaller loans and a lot more work. Your conventionals, yes, it's a lower margin, but it's a bigger loan amount. And those people are more organized, they've got all the documentation you need, they're easier. Well, I don't know how it is in your community, in your market. You've got to look at that and see who are my classes of customers or loans, and how do I want to pick and choose in that? Now, if you do that kind of analysis, that's a snapshot. Maybe it's this month, last month, maybe it's so far this year. But then you need to take that and plan into the future. What am I going to do about this? Well, if you decide that for you, conventional loans are really a better deal, works out better for you, but you happen to live in a first-time home buyer part of town where there's a lot of new construction, a lot of affordable homes, well, maybe then you need to drive to another part of town. Go hang out at the Starbucks in the other part of town. Go on the MLS tours in the fancy part of town, if that's what you want to go after. You know, you're going to have to craft your marketing and your sales outreach to match that future that you'd like to attain. Maybe it's focus on govie loans. Maybe it's focus on big loans. I don't know what it is. You've got to look at your city, what's available, and how it works for you. But think about that. Know who your worst customers are and know who your best customers are. Of course, we would like you to be one of our best customers, so if there's anything we can do to help, let me know. Speak to you soon.